Good morning. You're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Let's take a look at what happened in the global markets and get a sense of what happened. So most of the markets in North America did manage to do well. Most of the American markets, all the three, ended with positive bias. Europe, by and large, was trading with a positive bias. Asia has opened with a positive bias. And the SGX Nifty is indicating a gap up of almost 40 points, indicating a plus of almost 44 points. Now, remember, we were shut yesterday, but the SGX was working. The SGX was up almost 40 points in trade yesterday, which means that potentially we will have a gap up opening of close to 80 points when we open in trade above the 11,350 mark. Now, as far as the ADRs are concerned, all of them ended with a positive bias. You had your metal pack, Vedanta, which was up almost 1.5%. You have your private sector banks, which managed to gain. So overall, across the board, ADRs did manage to do well in trade. Now, how did individual sectors fan out in trade? The Nifty was down almost 44 points, but there was more selling that was seen on the broader market. The mid cap and small cap end of the market saw much more selling that came in. As far as the Nifty and the Bank Nifty is concerned, both of them ended with a negative bias. What did well, however, was the metal pack. The Nifty metal index was up almost 1.2%, but selling continues in the FMCG index, selling continues in the real estate index. Both of them were down over 1.2% in trade. Now, how did the fund flows pan out in trade? FIs were net sellers, DIs were net buyers, but overall on a month-to-date basis also, FIs have been heavy sellers in the market. It's been a market in which only domestic investors are active. What led to the fall in Nifty? Basically, private sector banks, the HDFC Twins, IndusInd Bank, all of them carried the Nifty downside, but a little bit of support coming in from private sector banks like Kotak as well as ICICI Bank. Tech Mahindra and Coal India were the other two counters that managed to gain. On the FNO side, what we're seeing is there was long unwinding that is seen on the Nifty. There are fresh short positions that were seen on the Bank Nifty fund, because if you're looking at the Bank Nifty, open interest build-up was 4%. Now, where are positions taken? Call writers are still active. They are writing in from levels of 11,300 right up to 11,600 in trade. Put writers have also positions, but 11,200 seems to be the support that the market is looking at. Even in trade yesterday, what you saw was that call writers were much more active in trade. And put writers were forced to shed positions in open interest as the Nifty started to drop in trade. Overall, if you're looking at the stocks in the FNO band, Adani Enterprises and Balrampur Chini continue to remain in the FNO band. The new entrant, however, is Wockhardt Pharma, which was down almost 2%. Nifty PCR, Bank Nifty PCR, both of them came down since the market was trading rather weak. But a couple of stocks that I want to point out. For the first stock being Jet Airways, saw fresh shots on low open interest build-up. The other counter that I want to speak about is Reliance Infra. Yesterday, on Wednesday, the entire ADAG pack was down in trade. So open interest build-up of just 1% on the short side. Long unwinding was seen on Reliance Capital. Again, ADAG stock trading rather weak in trade. And the final stock that I want to talk about is MCX, which saw short covering. Open interest was down almost 3.5% for the counter. But these are all the domestic cues that we are getting in. Let's go across to Jenna Dagenhart for all the top international headlines.
Canada admits the NAFTA talks are dealing with tough issues, but says all sides are working towards a deal. Foreign Minister Chrystia Freeland has had days of meetings with U.S. Trade Representative Robert Lighthizer and maintains her sole aim is to conclude an accord that's good for Canada. She says the two teams are in a phase of continuous negotiation, with more talks expected in Washington next week. President Trump's attacking OPEC once again. He's demanding lower oil prices as benchmark crude, Brent crude that is, nears $80. He tweeted that the U.S. protects oil producers in the Middle East, yet they allow prices to rise. Iran added to the pressure on OPEC by saying it will veto any decision considered harmful. Oil Minister Bijan Namdar Zangana says the 2016 supply deal is in tatters and the cartel has no authority to impose a new one. Facebook risks an EU regulatory clampdown and sanctions unless it yields to an ultimatum to stop misleading users on how their personal information is used. The bloc's Justice and Consumer Affairs Commissioner Vera Jourova says she's becoming impatient with the social network after 2 years of talks. The threat comes as Airbnb agreed to change its terms and conditions on pricing to meet EU standards. And Tesla can finally enjoy some good news. The Model 3 has aced all U.S. crash tests. The NHTSA tests simulate head-on collisions, crashes into side barriers, and rollovers, and the car earned the top 5-star rating on each one. The ratings will be a relief after months of Tesla crashes making headlines, particularly with incidents involving the controversial driver assistance system, autopilot. Global news 24 hours a day on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Jenna Dagenhart. This is Bloomberg.
I'm kind of unhappy to hear there's a recovery because, as you know, we're launching our new investment trust, and I want to be able to buy cheap stocks. So please don't push the prices up too much. But I think we've been saying for a few months now that, you know, we're nearing the bottom. It seems like things are very cheap. And even if we're not at the absolute bottom, it's a great time to be buying because there's so many bargains out there.
Okay, Matt.
What would make you more sure that we were at the absolute bottom? We've seen, Mark, these stocks, this is the MSCI Emerging Markets Index, come down 20% from their highs. Is that enough, just being in a bear market, or are there signs like consumer spending or a turnaround in the trade war that make you think we could turn around and go back up?
I don't think there's going to be a turnaround in the trade war with China and the U.S. yet. There's going to be more pain. But you must remember, there are winners and losers. So if you want to look for signs, you probably want to look at Turkey, Argentina, these countries that are really bombed out. And if there's a recovery in those countries, then it would be a sign that we're nearing the end of this big bear market.
And what about things that are outside the control mark of emerging markets themselves? The dollar, the path of the Fed, for example. To say it's time to buy emerging markets, do you have to say the dollar's, you know, nearly there? The Fed is nearly there. The Fed is nearly done with tightening, or can you buy emerging markets even if you expect a lot more Fed tightening to come?
Well, with more Fed tightening, because the dollar can get stronger, which is good for exporters in emerging markets. So what we see, a lot of the exports from China with this trade war will be going from other countries, other emerging market countries, Vietnam, Bangladesh, Turkey. All these currencies that have gone down dramatically are going to be the winners, in the sense that the countries with those currencies will be able to export more to the U.S.
Shifting focus to currency and bond markets, the rupee on Wednesday rebounded by a good 60 paise, or 0.8% higher versus the dollar at 72.38 levels. In fact, the home currency snapped its two-day losing streak after RBI intervened in the currency markets to restrict the rupee from breaching the crucial 73 mark. Well, speaking of the bond market, sovereign bonds too gained on Wednesday, as we have seen the 10-year benchmark bond yields dropping by 7 basis points to end at 8.07%, while on the global front, dollar index trades nearly to its 4-month low as emerging markets currencies rebounded amid improving sentiments. The index now trades lower for the third straight session. It trades well below the crucial 94 mark in the early Asian hours today. That apart, if you see pound, it rose over 1% yesterday versus the dollar, largely on the back of strong UK retail sales data. Also, euro trades higher for the third straight session versus the dollar today. That apart, if you see dollar rupee now, it is trading 40 paise higher in the non-deliverable forward markets near 71.95 levels, which indicates a positive opening for Indian rupee in today's trade.
Well, amongst the stocks to watch and trade today is Max India, which will be in focus as Life Healthcare South Africa has sold its entire 49.7% stake in Max Healthcare to Radiant Life for 2,136 crores. Now, how does this impact Max India? Well, Max Healthcare, the deal values Max Healthcare at 4,272 crores, and Max India holds about 50% stake in Max Healthcare. The current market cap of Max India stands at just 2,178 crores, suggesting some sizable upside potential in the back of the deal valuations. The deal, of course, will be completed before December 2018 is what they have said. Watch out for that name. Next on our list is Graphite India, which has clarified on reports of pollution caused by its Bangalore graphite electro plant and a recommendation of a shutdown. But the company has said that they're confident that the stack emission norms are well within the prescribed limits. So that let's see how that one reacts in trade today. You also have Fitch Ratings, which has revised the outlook on Tata Motors from stable to negative because they believe that there is expectation of a rising negative free cash flow over FY19 and FY20. The long-term issuer rating, default rating has been affirmed at BB+. You also have NBCC, which has updated on securing business worth 922 crores in August. That compares to just about 228 crores in the month of July. So watch out for that name. And finally, Dilip Bilcon has been declared as the lowest bidder for a Madhya Pradesh metro project worth 229 crores. So the stock might react positively on the back of this development.
Are there cyclical headwinds? Absolutely, which is the reason, if you'll recall, we used to be overweight on India within emerging markets for a long time. And last year in the fourth quarter, we actually took India a notch down from overweight to neutral because of these cyclical headwinds that you mentioned. Because as we all know, India has two key vulnerabilities: dependence on external capital, dependence on external oil. And both those seem to be going up. The cost of both seems to be going up. And it's difficult to really put a time frame as to when we reach the top there. And also, as you mentioned, we do have a meaningful political calendar, which means lesser policy flexibility. But that said, I guess there are positives too on the anvil. I think the one big positive that we see is that earnings growth is recovering, coming back after a long time. We've had 3 or 4 years of very anemic earnings growth for various reasons. And this year, I think, we saw the first quarter earnings growth of almost high teens. And we do believe that this year corporate India will deliver mid-teen earnings growth. So, that's a reasonably powerful driver of markets. And also, again, the big theme these days, obviously, is, the fear around trade wars. And, India being such a small part of the global supply value chain means we're relatively insulated. So the way I'd look at it is, it's not a glass which is full or which is empty, it's half full. I think the structural drivers are still very much in place. Be it demographics, be it the ability to absorb capital, be it the long list of reforms that have been implemented over the last 2 years. And yes, but there are cyclical headwinds, which is the reason we believe that, this is again going to be the next 12 months will again be a phase where, returns expectations should be modest. We are looking at about 10% returns for Indian equities in local currency terms. And of course, there will be attendant volatility and noise because of the election calendar.
Interesting. So, does this 10% odd returns, or whatever the number would be eventually at the end of the next 12 months, be hinging significantly on the delivery of that earnings growth? Because at 19-20 times, we are effectively pricing in a 20%
Absolutely, Neeraj, because the way we look at it is, the hard work will here onwards have to be done by earnings. See, valuations have expanded meaningfully. We're trading at 20-21 times forward earnings, as you mentioned. Very little scope for valuations to go up further. Because, a bulk of the reforms have been announced. We see very little scope for, big bang reforms to be announced over the next 8-10 months, given the election calendar. And on the margin, cost of capital is going up, both locally and globally, which would suggest that, valuations, if anything, have to derate gradually, which means the bulk of the hard work will have to be done by earnings growth. And that's where our construct of a 10% return comes in. We're looking at 15% earnings growth, but we do believe that you have to keep some margin of error for valuations derating, and which is the reason we're calling for 10% return from the markets.
I get nervous when I hear that India needs more resources in NRI bond because, we started this process with $450 billion of reserves across spots and forwards, which by any measure is of, given our current account and future gross financing requirements, is adequate. So we've got plenty of reserves to finance any balance of payments gap at this point in time. And the RBI, can still use that. Now, I think the balancing act here, Ira, is that you don't want to use too many resources too quickly, because what's driving this are global phenomenon and global risks that may just persist for a while. The genesis of a lot of this is a stronger dollar because of US exceptionalism and the fact that the Fed will have to raise rates. That isn't going away. In the second half of the year, we expect the US will grow at 3%. we think for the Federal Reserve Bank, just to reach their definition of neutral, will require at least 3 to 4 more rate hikes. And, most people would expect that the Fed at least has to go to neutral, given where their economy is. Growth is well above potential. The unemployment rate's the lowest in 20 years. Wages are picking up. In the 10th year of an expansion, payroll numbers are at 200,000. All this smacks of some overheating, and therefore the Fed will have to raise rates at least 3 or 4 more times. We know that trade war between the US and China is escalating by the week. So this could be a long, hard winter for emerging markets. And in that environment, the balance has to be that I don't want to use too many of my reserves as India Central Bank too early and have enough buffers left for the coming months. At the same time, I also want to try and reverse these one-sided expectations in the market.
Sure. Sajjid, to the point that you made earlier on spreading this correction over multiple instruments or multiple aspects, I think Jahangir was making the point in a conversation earlier that you need to use interest rate in that. And his argument was that we have to look at CAD from the savings investment side. And if you look at it from that perspective, then higher interest rates have to be part of the solution. As the chief India economist, I'm going to ask you to fit that into the current Indian scenario. Given our growth inflation mix, do we have the option to use interest rates very much?
So I don't think there's necessarily an inconsistency here, because I think, firstly, the framework that the RBI is using has worked very well so far. And I think we should not fundamentally abandon the framework. Now, the framework itself is a flexible inflation targeting framework. So what the MPC has done well in the last few meetings is look forward and say, when the base effects wear off, where is inflation in the first 3 or 6 months of next year? And most of us forecasts are, at 5%, which the MPC deems will require some monetary policy response, and therefore you saw rate hikes in June and August. Now, what's happened since the August meeting? Oil prices have gone up almost 10%, and now expectations are that even $80 could be breached, because Saudi Arabia said 2 days ago that they're comfortable with oil prices above 80. And the currency, inevitably has weakened along with other emerging market currencies by about 5%. So my going forward, I think the cost push inflation that you saw earlier in the year will continue, because of higher oil prices, because of the weaker rupee. Yes, we're getting some relief from food prices, but we can't be sure how long that will sustain, given that MSPs have gone up quite a lot. So I think just using the existing framework, when you project inflation forward 6 months, at least in our models, we get inflation, headline inflation above 5%, and I think that will entail, some monetary tightening. I think we should not deviate from the course. Our expectation is we get a 25 basis point hike in October, maybe 1 more in December. Just looking at where inflation will be in the coming months. I know the MPC had said they'd rather it be closer to 4% and not closer to 5%. So at closer to 5%, you will need to respond, and that will help bring the current account down, because slightly tighter monetary conditions and sticking to your fiscal target should temper the current account deficit, along with the fact that later, with the lag, also the 7% real depreciation we've seen this year should also help. So I think policymakers will have the mix right, that multiple instruments will and are being used to try and narrow the current account deficit.
Moving on to some stocks to watch then, the first stock on the list that you should keep, that would be Reliance Infra. Now that was down about nearly 10% in trade and saw delivery selling of more than 50 crores. The delivery volume surged about 150% as the total volume rose just over 90% when compared to its 5-day average. Second stock to watch out for, Sun TV. That too was down about 2.5% and saw delivery selling of nearly 60 crores. The delivery volume surged about 99% as the total volume surged just about 20% when compared to its 5-day average. Last and final stock on the list is Edelweiss Financial. That was down about nearly 6% in trade and saw delivery selling of 51 crores as well. The delivery volume surged about 90% when the total volume surged 77% as compared to its 5-day average.
What propelled you to say, I'm quitting this, I'm going to start a company selling books over the internet, and I'm going to do it from Seattle? Where did that idea come from?
I came across the fact, so this is 1994, Nobody has heard of the internet, very, very few people. And I came across the fact that the web, World Wide Web, was growing at something like 2,300% a year. This is in 1994, and anything growing that fast is, even if its baseline usage today is tiny, it's growing so fast, it's gonna be big. And so I looked at that and I was like, there's gotta be, I should come up with a business idea and that get, on the internet, and then let the internet grow around this, and we can keep working on it. And so I made a list of products that I might sell online, and I started force ranking them. And I picked books because books is super unusual in one respect, which is that there are more book items in the book category than there are items in any other category. There are 3 million different books active and in print around the world at any given time. So the founding idea of Amazon was to build universal selection of books. The biggest bookstores only had 150,000 titles. And so that's what I did, and I hired a small team, and we built the software. I moved to Seattle.
And when you told your parents you were going to quit D.E. Shaw, where you're successful, making presumably a fair amount of money, and you told your wife, Mackenzie, that you're going to move across the country, what did they all say?
They were immediately and reflexively supportive right after they asked the question, "What's the internet?" Right. And so no, but this is right. With your loved ones, you bet on them. You're not betting on the idea. You are betting on the person, and that was that. And it's one of those decisions I made with my heart and not my head. And I basically said, I don't want to regret. When I'm 80, now 90, I want to have minimized the number of regrets that I have in my life. And most of our regrets are acts of omission. They're things we didn't try. It's the path untraveled. Those are the things that haunt us.
All right, several stories just like that one on the website bloombergquint.com. There are a couple that you should definitely read this morning. Here they are. The government has increased interest rates on small savings schemes by up to 40 basis points for the October to December quarter, according to an official notification. And in huge news in the international aviation space, Dubai's flagship airline, Emirates, is looking to take over unprofitable neighbor Etihad, according to 4 people familiar with the matter. If it goes through, it would create the world's biggest carrier by passenger traffic. Both airlines initially declined to comment before later denying that any talks were underway. That's all you need to know going into trade today. Up next is Indian Open, so do stay tuned. This is Bloomberg Quint.